Hey everyone, welcome back to Corporate Decoder. Today we are diving into the financial underbelly of Cloudweb Incorporated, and let me tell you, it is a journey through a financial landscape that makes you wonder if they are building a cloud or just, well, let's just say things are a bit murky. This is their latest report, a Form 10Q, which is supposed to give us a snapshot of how the company is doing. Cloudweb Inc. tells us they are exploring new ways to market their web hosting and data storage services, even talking about making hosting free and relying on ads. Sounds interesting. But let's see what the numbers actually say. So first up, the balance sheet. This is like a financial x-ray of the company at a specific moment. We are looking at two dates here, the 30th of September 2025 and the 31st of December 2024. And here is the kicker. For both of those dates, total assets are listed as $0. That's right, zero. And to match that, total liabilities and stockholders' deficit are also listed as zero. This is highly unusual, almost unheard of for an active company. It makes you question the very existence of their reported assets or how they are accounting for them. Even though total assets are zero, they do report some liabilities. For the 30th of September 2025, total current liabilities are $699,036. This is up from $643,494 at the end of 2024. So, while they may not have assets, they definitely have bills to pay. Now let's look at the stockholders' deficit. This is where things get really grim. For the 30th of September 2025, the accumulated deficit is a staggering $233,516,449. That is a huge negative number, meaning the company has lost way more money over time than it has ever made. This is also ballooned from $233,460,907 at the end of 2024. Let's move on to the income statement, or as they call it here, the condensed statements of operations. This tells us how the company performed financially over a period of time, in this case for the 9 months ending the 30th of September 2025, compared to the same period in 2024. For the 3 months ending the 30th of September 2025, their net loss was $14,845. That might not sound like much, but it's an increase from the $12,441 net loss in the same period of 2024. The increased loss is attributed to higher professional fees. Looking at the bigger picture, for the 9 months ending the 30th of September 2025, the net loss was $55,542. This is actually a slight improvement from the $57,476 net loss in the same period of 2024. So, while they are still losing money, the rate of loss has slowed down a tiny bit. This decrease in loss is due to a drop in professional fees. Now, the statement of cash flows. This is crucial because it shows us where the company's cash is coming from and going. For the 9 months ending the 30th of September 2025, the company used $31,315 in operating activities. This is similar to the $31,050 used in the same period of 2024. They are essentially burning through cash just to keep the lights on. Where is this cash coming from then? Well, it's coming from financing activities. For both 9-month periods, they received $31,315 in 2025 and $31,050 in 2024. This is described as advancement from related party, which means a director of the company is personally lending money to keep the business afloat. That's a big red flag when a company's only source of cash is from its own insiders. And this leads directly to the going concern note. This is a standard but extremely important disclosure. The company explicitly states that its existing capital resources may not be enough to carry out its business plan. They say this raises substantial doubt about their ability to continue as a going concern. This means there is a real possibility the company might not be able to survive. They are hoping for more cash, but if they don't get it, they might have to scale back or even shut down their plans. This note to the financial statements is really important. It details how the company's director advanced money for operating expenses. As of the 30th of September 2025, the amount due to this related party was $204,374, up from $173,059 at the end of 2024. This reinforces the idea that the company is heavily reliant on its director for funding. Here is a look at their convertible notes. These are like loans that can be turned into stock. We see a lot of notes, some dating back to 2017 with various interest rates and maturity dates. It's quite a complex web of debt. For example, the convertible notes from July 2017 had an original expiry date of the 30th of June 2019. But it has been extended multiple times. And this particular convertible note from July 2017 is currently in default, which is a serious issue. They also mention a reverse stock split, which often happens when a company is trying to boost its share price, which is usually a sign of underlying financial weakness. Under equity, they mention their authorized common stock, which is 500 million shares. As of the 30th of September 2025, they had issued and outstanding shares of 27,819,385. This means they have a lot of authorized shares, but a significant number are already out there. The company identifies a single reporting segment, web hosting and data storage services. They state their chief operating decision maker evaluates performance based on net income. The interesting part here is their plan to make hosting free, supported by advertiser content, and to explore white labeling their services. This section is where management talks about their perspective on the company's situation. They include a lot of forward-looking statements, which are basically educated guesses about the future. They even specifically warn investors not to place too much reliance on these statements. They reiterate their business, web hosting and data storage services through brands like hostwiser.com, w8hosting.com, and jcloud.com. They also mention they have never declared bankruptcy, been in receivership, or involved in legal proceedings. Looking at the results for the 3 months, the company discusses a 73% increase in operating expenses, primarily due to professional fees. This led to the increase in net loss we saw earlier. For the 9-month period, they report a 6% decrease in operating expenses, which led to a slight decrease in the overall net loss. So, they are managing some costs, but the revenue side of the equation seems to be missing entirely from these statements. Under liquidity, they again highlight the working capital deficiency. As of the 30th of September 2025, it stood at $699,036, a significant increase from the $643,494 at the end of 2024. This is mainly driven by increases in accrued interest and amounts due to related parties. They are clear that they have not generated positive cash flow from operating activities. This means the core business operations are not producing enough cash to sustain themselves. And here they are again repeating their going concern warning with an accumulated deficit of over $233 million and no assets reported. The company's survival is very much in question. They really emphasize they need more financing to continue. In this section, management admits that their disclosure controls and procedures were not effective. This is a really serious admission, meaning the information they are providing might not be fully accurate or timely, and could even be misleading. They're saying they aren't sure if all the information is recorded, processed, and reported correctly for timely disclosure. Finally, we come to the signatures. G. DeLau appears to be wearing multiple hats here. Hez signing off as President, Chief Executive Officer, Chief Financial Officer, and Director. This concentration of power and responsibility in one person can sometimes indicate a small operation. But coupled with the financial picture we've seen, it also raises questions about oversight and internal controls. So, what's the story here? Cloudweb Incorporated presents a deeply concerning financial picture. They report zero assets while carrying significant liabilities and an enormous accumulated deficit. Their operations are not generating cash, and they are wholly dependent on loans from a director. The very fact that they have admitted their disclosure controls are not effective adds another layer of risk. It seems the company is in survival mode, with its future hanging by a thread. Relying on external funding and a business plan that involves offering services for free. This is a high-risk situation for any investor, and frankly, it raises more questions than it answers about the fundamental viability of Cloudweb, incorporated as a going business. Alright, that is our deep dive into Cloudweb Inc., his latest filing. What is your take on these numbers and what they signal for the company's future? Do you think this free hosting model can ever work? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description for more discussions. Thanks for watching. See you next time.